Mr. President, as I've said before, when it comes to the actions of government, it's often legislation that grabs the biggest headlines. But it's equally important to focus on what a presidential administration is doing with its regulatory power, something I was reminded of again last week when I signed on to a letter headed by Senator Cassidy on the Biden administration's proposed new overtime rule. Because in the modern regulatory state, presidents have a tremendous amount of power to affect our economy and federal policy through regulation. And today I'd like to take a couple of minutes to talk about some labor regulations coming out of the Biden administration that are likely to prove detrimental to workers, business owners, and our economy. And let me start, as I mentioned, with the Biden administration's proposed new overtime rule. This proposal would impose a 55% increase in the exemption threshold for providing overtime pay for covered employees. Currently, employers are required to pay covered employees, employers, I should say, are required to pay covered employees making less than $35,568 per year overtime if they work more than 40 hours per week. Under the Biden administration's proposed new rule, employers would be required to pay overtime to covered employees making less than $55,068, as I said, a massive 55% increase in the exemption threshold. So what would be the effects of this proposed rule? Well, it would likely result in some combination of higher prices, fewer job opportunities, and lower base pay for employees. Because employers, and I'm thinking particularly of small businesses who are always going to be hit hardest by regulations like this, are going to be forced to look for ways to offset what could be a substantial increase in costs. Indeed, many small businesses will have to find some way of offsetting this cost increase if they want to stay profitable. And so businesses large and small are likely to compensate either by increasing prices on their goods or services, reducing the number of positions that they have available, or lowering the base pay to create room to pay overtime wages. And needless to say, none of these are attractive options for workers, consumers, or businesses. Consumers are currently stretched to their limit with price hikes in the Biden economy. And lower base pay or fewer available positions are not attractive options for American workers. And by the way, you don't have to take my word for it on that lower base pay. The head of President Biden's own Council of Economic Advisors has previously noted, and I quote, "The costs of increased overtime coverage would ultimately be borne by workers as employers set base wages."
Well, friends, I have breaking news to share with you this morning. A group of lawmakers in the House of Representatives have just approved a new bill. This piece of legislation will temporarily expand the standard tax deduction, which is used by millions of Americans. Once enacted into law, taxpayers can expect to qualify for as much as $4,000 in tax relief. My dear friends, please do me a big favor and watch until the end of this video for the latest breaking news. Also, this coming Friday, I will be announcing several winners for the Walmart gift card giveaway. If you would like to enter these weekly giveaway, friends, all you have to do is click and like several of my videos and then comment below the video of each video that you watch. Remember, the more videos that you watch and then comment on, friends, the greater your chances of winning these giveaways. A House panel has passed a bill that would temporarily expand the standard tax deduction used by the majority of taxpayers by $2,000 per person for the next 2 years. The Tax Cuts for Working Families Act, secretly approved by the Tax Writing House Ways and Means Committee, would boost the standard deduction by $2,000 for single filers and $4,000 for married filers for the years 2024 and 2025. The deduction would start to phase out for single taxpayers with a $200,000 in income, or $400,000 for joint filers. A financial advisor can help you optimize your tax strategy and make sense of tax code changes. GOP Representative Carol Miller told Yahoo News, "The vast majority of my constituents use a standard deduction on their taxes every year. She noted that the measure will increase economic activity in local economies. Nearly 2/3 of households would receive a tax cut in 2024 under this proposal. However, since a standard deduction lowers the amount of income subject to taxes, the deduction is not refundable and would not provide cash to lower income taxpayers. Only a small percentage of the bottom 20% of households have enough income to get a tax cut under this proposal, but those at the very top of the income ladder also would not see significant tax savings if the bill becomes law. So not only does a higher deduction phase out for larger incomes of $200,000 or more, but there is a big proportion of high-income households who use itemized deductions. The change would also cost approximately $96 billion over 10 years. The standard deduction for 2023 will be $13,850 for singles and $27,700 for couples. The deduction nearly doubled as part of the 2017 Tax Cuts and Jobs Act, which expires in 2026. An increasing number of taxpayers have opted to claim the standard deduction rather than itemized deductions. And according to the IRS, 90% of taxpayers opted for the standard deduction for their 2021 taxes. Also, friends, funding cuts could be coming for the Education Department, and key programs for student loan borrowers are at risk. So far, the House Appropriations Committee has passed 7 of its 12 bills to fund federal agencies in the upcoming fiscal year. The committee released details for one of the remaining bills, the Labor, Health, and Human Services, Education, and Related Agencies bill, and the proposed budget cuts are significant when it comes to FSA, or Federal Student Aid specifically, which oversees student loan repayment and servicing. The committee's cuts could put programs that many borrowers rely on at risk. The committee wants to fund FSA at $1.8 billion, which is $264 million below its current level, and nearly $884 million below what Biden requested. The committee targeted a range of the Education Department's recent initiatives to provide relief to borrowers, including streamlining the process for borrower defense to repayment. And if approved, their loans would be completely wiped out. The GOP lawmakers said their bills include legislative language prohibiting funding for improving that process. The funding cuts would come just over 1 month into federal student loan borrowers' return to repayment after an over 3-year pause. In October, student loan borrowers' bills started becoming due again, and millions of them have been faced with a range of errors, including late billing statements and inaccurate information on their accounts. Regardless, the issue of funding remains a top concern. Deputy Undersecretary of Education Ben Miller said during a debt relief negotiation session that the department's been seeking funding increases for federal student aid. He also noted, "We are not in the position where we have significant resources to add large numbers of staff." That is the end of my daily stimulus update video for today. Dear friends, thank you very much for joining me here on a daily basis. This coming Friday and every Friday, I will be announcing several winners for the Walmart gift card giveaway. Please make sure, friends, that you enter the giveaway by clicking and liking several of my videos, and then comment below the keyword of each video that you watch. The more videos that you comment on, friends, the greater your chances of winning these giveaways. Thank you and have a wonderful and very blessed day.